I appreciate you all joining us today. My name is Logan Reed, and I'm one of the advisors with Eganberger and Weiner. And today it's my pleasure to present our 2025 Economic Outlook webinar. So it's the start of a new year, and as always, there's a lot of different factors impacting the economy, the markets, and ultimately your financial goals. Things like interest rates, inflation, they've been making headlines for a while, but there's also new factors like changing political environment, tariffs, regulatory changes, you name it, it's making a headline. So as we go through the presentation today, please send any questions that you have either to the Q&A section at the bottom of the screen, or you can email me directly at lreed, L-R-E-E-D, at ebwllc.com. So today we're very pleased to welcome Mr. Paul Single from City National Rochdale as our lead presenter. Some of you may recognize Rochdale as one of the partner portfolio managers that we use, and they're a valuable resource for us and to you as well as our clients. Paul joined Rochdale in 2003, and he has 40 years of experience managing investment portfolios. He's responsible for the research, analysis, and implementation of various fixed income strategies. He's also a voting member on the firm's investment strategy committee, which determines the most appropriate balance of investments for client portfolios. Mr. Single is a frequent lecturer and on the economy and investments, and he's a contributing author for the monthly and quarterly economic reports. Prior to joining City National, Mr. Single managed fixed income portfolios at Wells Fargo Bank, Wells Fargo Capital Management, and at the Benham Management Group. So with that said, Paul, thank you very much for joining us, and I will let you take it from here. Sure. So as we wait for Paul to get in, I'll just kind of reiterate, what's happened over the last couple of years to get us to where we are today. So, the biggest thing, obviously, coming out of 2022 was what is happening with inflation and interest rates. So if you looked at, at that point, that was one of the fastest increase in rates in history. And that was because inflation was running very hot, hotter than it has in at least the last 20 years. So that turned into a negative for the bond market, subsequently a big negative for the stock market as well. But that was 2022. Since then, 23 and 24 interest rates have still been relatively high, and have only recently started to come down. But the stock market has actually done very well in both 2023 and 2024. To this point, most folks have recovered anything that was lost in 2022 and are now back to the point of showing a profit. But that being said, that's in the past, and what we're trying to focus on here is, what is coming now. I know one of the biggest topics of last year, obviously, was the election. And if you haven't watched it already, there's a very good presentation that we hosted at Wolf Trap a couple of months ago, talking about the economy and the election. And how often does an election impact the economy as a whole? And obviously there are things like regulatory changes and, policies that do have some kind of impact on the economy and the stock market. But what the presenter that we had at that in that segment did a very good job of basically saying it does not impact it nearly as much as you think. It looks like Paul has made his way in. Paul, are you ready?
I am ready.
Okay.
Thank you. Are you able to see the screen?
Yes, I can.
Oh, wonderful. Thank you. Thank you so much. And thank you all for joining us today. There's an awful lot going on with the economy. The new administration has a lot of big plans centered around lowering taxes, reducing regulation, actually increasing taxes on tariffs, and also with immigration. And these are all really big impact decisions that are being made. And normally you don't see that sort of thing at this stage of a business cycle. The economy is doing extraordinarily well. Job growth has been robust. The unemployment rate is very, very low. The consumer is spending an awful lot of money. So again, you don't see big changes in this sort of environment because everyone's pretty happy with what's going on. Usually these big changes happen when you have a very high level of unemployment. But fortunately, that's not the case. So what I have today is a presentation that has an awful lot of charts in it to discuss various topics, because what we don't know is what will be implemented. We know what was talked about on the campaign trail, but we also know that a lot of things are talked on campaign trails over time. But by and large, I think you can assume that the president will be implementing as much as possible, but the degree or the severity of each one of these changes, we don't know. And that's what's going to determine the trajectory of the economy going forward. But just to take a look at what we've got going on right now, I have a bunch of charts, as I mentioned. The chart on the left is the broadest measure of the economy. It's measuring the GDP, the gross domestic product, and it's measuring it from 2015 to the present, and that's in dollar terms. The gray columns, when you see them in economic charts, that represents recessionary periods. So the chart on the left, you can see GDP growth was at a pretty linear pace for the 5 years or so before the pandemic started. The pandemic did cause a recession so severe that we haven't seen anything like it since the Great Depression. But you can see we've bounced back from that. A lot of stimulus programs from the federal government, along with the Federal Reserve Bank being very, very active in its policies to lower interest rates and to buy an awful lot of bonds, help people refinance their mortgages at a much very low rate, giving them a cash flow to spend money. And that's really what drove us out of the severe downtrend that we had. But what's interesting is that you can see the dark blue line. It's above that light blue dotted line, which was what the trend was beforehand. This economy is back on track as if nothing happened, net. So it's showing that the United States has done quite well. But the chart on the right, I think, is the more powerful chart. This chart here, it's a column chart. It just shows the amount of economic growth the United States has had since the end of the pandemic recession, and it's up around 11.5%. Take a look at our major trading partners. You can see that that growth is roughly a third of what we have in the United States. It's come nowhere as close. In the UK, they're still licking their wounds from the 2016 vote for Brexit. That's really severely impacted their financial markets, GDP growth. The Eurozone, to some extent, the same sort of thing. Plus, they had some mistakes that they made with their central bank with the negative interest rates. Japan, if this past year was the first time their stock market surpassed the highs of 1989. Following that, there was what they called the lost decade that lasted about 3 decades, were very, very slow pace of economic growth, very little inflation. And of course, China is dealing with its problems pretty much centered around the real estate problems that they have there. So the United States economy is doing extraordinarily well. One of the biggest reasons for that is a very low unemployment rate. This chart here goes back to 1950, and there's a lot going on here, so bear with me. So the dark blue line is just showing the unemployment rate, which is at 4.1%. Economists generally view anywhere from 4 to 4.5% as full employment. You know, there's always people that just quit a job. There's always people that just got fired. There's always people coming into the workforce and so forth. So there's that group that's not employed. But this is considered a very strong level of growth for the labor markets when you have an unemployment rate so low. And as you can see, seeing it at that range or below that range for a sustained period of time is pretty rare. We had a good economy before the pandemic started, but the only other times we've seen something like that, you can see, was in the early 1950s and the late 1960s. And if you think about it, it's because we were at war at either Korea or Vietnam. And then there was a whole group of young men that were not in the labor force looking for jobs. So that's what pushed the unemployment rate down so much. This time around, it's because the economy is so strong. And there are some demographics going on. Baby boomers are retiring at a little faster pace than what we had seen for the decades beforehand because they have the wealth to be able to do so. But a very low unemployment rate is what's helping this economy. And you can see that over on the right-hand side. This is an interesting chart in terms of the supply and demand. Many heads of the Fed have often said that this is really what they look at in terms of trying to understand the strength of the labor market. And so the dark blue line is the amount of people that are looking for a job. The light blue line is the amount of job openings. And right now, there's about 1 million more job openings than there are people looking for a job. That's a strong economy. That means businesses want to expand, but there's just not enough labor out there to help them. But that's a very, very good situation to be in. And it looks as though it's going to continue to do well for some time. This is the report for those that are applying for unemployment insurance for the first time. This is what economists refer to as the canary in the coal mine. When you start to see layoffs happening, that's when the economy starts to weaken. But you can see in this chart here, which goes back to about 1970, that the amount of people applying for unemployment insurance for the first time is at near record lows. Their businesses are not giving up their employees, although there are a lot of changes ahead, a lot of uncertainty ahead. AI is probably one of the biggest ones for a lot of people, but also changes that the administration is talking about. Businesses are not nervous at all. They're not laying off people. And that's, again, another good sign of strength for the economy. There's still some stimulus in the system from the pandemic, and most notably is coming from the Federal Reserve Bank. As I mentioned, what they did following the pandemic is they entered in what they called quantitative easing. It's sort of a funny term, but what essentially they did is they went to banks and said, we want to buy your bonds. So they would go to a place like Bank of America and say, please sell us 500 million or $1 billion in bonds and so forth, and we'll credit your account with reserves. The Fed can do that. They can make up currency. But by doing so, it pushed up the price of bonds, pushed down the yields, so people were able to refinance an awful lot of debt. And that, again, as I mentioned earlier, allowed people to start spending money, because this is the interesting thing about lowering interest rates. Lowering interest rates by itself doesn't do much, especially when people are very nervous about the outlook. Old joke of bankers is that you can lead a horse to water, but you can't make it take out a loan. Bankers aren't all that funny, but that's their joke. But by allowing people to refinance their debt, that cash flow is permanent. That's locked in. For most people, they locked it in for another 15 to 30 years, that low rate. Positive cash flow that they can count on month in and month out, they're apt to spend, and that's what drove the economy. Because with the U.S. economy, 60% of it is people's spending. Your spending is somebody else's income. So it worked very, very well. The point here is you can see that the Fed still owns an awful lot of bonds, much more than they had before the pandemic. And so that helps keep interest rates a little bit lower than they would normally be. And also the federal government. The federal government is very, very generous with spending money compared to how much that they bring in. And that's what this chart is showing. From 1970, it's showing the percent of spending relative to the amount of revenue that they bring in. And right now, they're spending about 140% of what they bring in. That's a lot of spending. And it's not new, as you can see. For the last 15 years, they've been averaging about 140%. Now, some of it, you needed it because of the pandemic. But some of it you still need because we did need infrastructure spending. We did need to bring back important industries back to the United States that we can rely on, such as chip making, pharmaceuticals, that sort of thing. But no matter how you push it, that's still more money than what they have. And that, of course, is stimulative. It's no different than you having a lifestyle where you can keep charging 140% of your income on your checking on your income and not have to worry about the consequences at all. But also another thing that's changed people's behavior in terms of why they feel comfortable spending money is that they feel rich. And that's because they are. And I'll get into that in a little detail in terms of the demographics. But when you take a look at the overall average of the population, they're benefiting from the fact that the stock market has done so well. It's up more than 80% since the peak before the pandemic. You can see previous times how much the stock market had traded down in a recession, but that really didn't happen this time around. And another measurement of wealth is the value of their home. And this one's a little bit more important in terms of people's behavior. The stock market, they know, will go up and down, up and down. The housing market, they know, generally speaking, it just goes up. Data that goes back to around 1990 or so shows that on a year-over-year basis, outside of the global financial crisis, housing prices only once had a negative return on a year-over-year basis. Now, the housing crisis, of course, was something weird. Should never probably have happened, but it did. And if you recall, it was very easy to get a mortgage back then. The running joke was that, if you had a subscription to TV Guide in good standing, that was good enough for someone to lend you money. They didn't require you to prove your income. They didn't require you to prove the value of the home. You didn't even have to pay principal on that mortgage. You could just pay interest payments. So people levered up and they bought a lot of homes. And as soon as the teaser rate went away, they couldn't afford it anymore. And that started the collapse. Now, if any of you have refinanced in the last few years or bought a house in the last few years, you know how difficult it is. We work for a company that's owned by a bank, and I got my loan through the bank. It must have been 20 hours of work proving what they needed: insurance, income, value of the home. I mean, it took 2 days to prove I worked and had an income. And I said, all you have to do is send me an email, I'll return it. But banks are banks. It's very difficult. So there's not that risk. And there's not a risk of that ever happening in the near future. 40% of the people that own a home, I mean, individuals, we're not talking corporations, don't have any mortgage on it. Of the 60 that do, the value of that mortgage is around, the value of the home is about 40% more than the value of the mortgage. So even if they did run into financial problems, they could easily sell their home probably at a profit, and everything would be okay. But here's some charts here. I don't want to get too deep down the rabbit hole on things, but Americans are, by and large, doing very, very well. The chart here on the left shows household net worth. So these are all your assets minus your liability. So it's the value of your home minus the mortgage. It's the value of your car minus the car loan, that sort of thing. And what's interesting is that from roughly 1970 until about 2010, it was growing at about the same pace as the economy. But you can see, which then the economy being that dashed line, you can see it's growing at a much faster pace. Households are becoming much, much wealthier than they ever been before, and for good reason. And you can see that on the right-hand side. The assets are appreciating very quickly, but the liabilities aren't. It's not like they're leveraging up their portfolio or their balance sheet. Baby boomers who were big at borrowing money don't need to anymore. The kids have moved away. The house is close to or paid off. Kids' education's been paid for. They don't need to lever up like they did beforehand. And the younger generation has never been one to want to lever up like their parents, the baby boomers, did, because they saw the dramatic change that it had when the house value fell by, on average, around 30 to 35% for a period of time. That really impacted an awful lot. So balance sheets are in very, very good shape. So if we do get an economic slowdown, and we will at some point, we don't have that big payment that needs to be made like it was beforehand. And so that leverage story that I was talking about, it has really changed. Americans are in great, great financial shape in terms of their balance sheet. This is all the household leverage that you can see from 1950 to the present. And it was on a long upward trajectory. Again, baby boomers had no problems borrowing money, and it worked out well for them. But, the younger generation doesn't want to do that. And you can see the dramatic reversal that we've had since the global financial crisis. It's really changed. So households are in great shape. Not only are they wealthy, but they don't owe much money. What's interesting is what's happened over time. This is the amount of income that comes into households, and it's measured in all sorts of ways. It's your salary or your wages. It's if you have investment properties, it's your rental income, it's the coupon payments on bonds, it's dividend payments on stocks, and so forth. This is measuring it since 2020. So you can see the very far left what it was like before the pandemic, which came in February. Those three spikes that you see there, those are the checks that were sent out by the federal government. But it has continued to grow over that period of time. If we add in inflation, you can see that wages are growing faster than inflation on average. So these are the two most popular measurements of inflation. The CPI is the bright blue. That's the Consumer Price Index. That's what's used for adjusting things like the cost of living adjustments for Social Security and union contracts and so forth. The dark blue one, this is the one that the Fed pays attention to in terms of inflation, because this is based on how people actually spend their money. They take a look at the actual products that are being bought, and they are able to figure out what that is. So in this case, the word core that you see there, that means they take out food and energy prices. And they do so for a couple of reasons. One, they don't have any impact on food or energy prices, no matter what the Fed does. And two, those two tend to be volatile. Food really is related to usually weather. Now it's disease, like with the avian flu. Energy prices, well, it's really heavily driven by OPEC, which is geopolitical concerns, not supply and demand sort of concerns. So they take that out. Plus, the Fed's job is to forecast inflation. And the best way to forecast something in the future is take out the parts that are the most volatile. It makes it a whole lot easier. But as you can see, income on average is growing faster than inflation. But here's the shocker. This is spending, the dark gray. Now you can see where it dropped in early 2000 because of the pandemic. But notice that spending is stronger than income, which is extraordinarily rare. And this is really the driving force behind the economy, is this strong spending in the United States. At first, coming out of the pandemic, people just spent an awful lot of money doing things that they could do, in terms of experiences with friends. We saw the same sort of thing after World War II. You had 12 million troops returning home. The rationing was gone. People celebrated because they realized that at any moment, their best friends or their loved ones could be gone. And so we had very, very high inflation. The same thing happened after the pandemic. People had the money, and they spent a lot of money. But like after World War II, that lasted about a year or two. And all of a sudden you realize, well, we got to get back to what real life is like. But what's interesting is people are spending. And at first it was because they saved an awful lot of money, and they were spending that down because you weren't driving to work. Excuse me. You weren't stopping off at Starbucks. You weren't doing this. You weren't doing that. You weren't going out to lunch. People had built up strong savings. And so that helped propel the spending. But now it's being attributed to all the baby boomers that are retiring because they're no longer earning an income, that shaded area, and they're spending down, the money that they've been saving all along. And that's what's driving the spending part, but that's what's driving economic growth. So what the Fed has is exactly really the sort of situation of what they want. The Fed's responsibility is to keep inflation low and stable, and the unemployment rate low and stable. The chart on the left is showing the Consumer Price Index. The yellow line that you see there, that's their target. They want it to grow around 2%. You need some inflation, and low and stable around 2% seems to be the right number. The light blue vertical line that you see there, that's when the Fed started raising interest rates because they had brought them down to near zero. And as you can see, as soon as the Fed started raising interest rates, inflation peaked shortly afterwards, came crashing down over the next year. I mean, that was the biggest decline in yearly change of inflation we've had outside of a recession. Stabilized. It's still hovering around 2.5% to 3% or so, a little bit above what their target is, but it's pretty darn close, and they're not worried about it taking off. But what's interesting is when the Fed does raise interest rates, usually there's a risk of a recession, but that didn't happen this time around. And you can see that on the right-hand side. The unemployment rate is a little bit higher than what it was when the Fed started raising rates, but Not much. These are still very, very low numbers. And this is attributed to the fact mainly that Americans are pretty insensitive to interest rate increases because so many of them are able to refinance their mortgages that helped out quite a bit. So they don't notice it as much. Plus the savings and the wealth creation that has happened that I just talked about in the previous charts. That's where we stand. So the question is, what's going to happen in the future? To us, the biggest risk is geopolitical risk. You got two wars that are going on. One might be slowing down, but I don't think anyone thinks the Middle East is all of a sudden going to get calm. There's a great deal of uncertainty there with some possible changes going on. And of course, the war in Eastern Europe is also a very big concern. Plus, having tariffs, that doesn't make many countries very happy. So geopolitical risks are quite high. In regards to tariffs, there's a long history of tariffs. Now, tariffs are just simply a tax on imports. And for the longest time in the US history, that's pretty much where we got, or the federal government got its revenue. Pretty much since the Revolutionary War till the Civil War, almost all the money came from that. In the mid 1800s, they started excise taxes. Lincoln tried an income tax to help pay for the Civil War, but that was found to be unconstitutional and they got rid of it. Didn't come in until the 1900s. But this chart here just shows the revenue that's been coming in from tariffs. There have been various policies that have been put in place. The Smoot-Hawley is probably the most famous in terms of very large tariffs on imports in the United States. The story on this with economists, I'm not sure how true it is, but I've heard it so many times that you think it's true. Anyway, the Wall Street Journal had a survey asking 1,000 economists, should the Smoot-Hawley tax be approved? And 1,000 economists all agreed and said, no, it would grind global trade to a very, very low level, and unemployment rates would increase significantly. And the story on this is the first time in history that not only did 1,000 economists agree on one thing, but actually they were right about it. And that's exactly what happened, because as soon as you put a tariff on another country, they retaliate and do something else. So it slowed down trade quite a bit. Shortly after that, it was reversed. Congress gave FDR the ability to negotiate an awful lot of tariffs. That's still in play today. That's why the president can do these sort of things, because actually it's the Constitution that says Congress is the one that does that, not the president, but Congress has relinquished that to the president. And tariffs sort of fell by the wayside. The main reason for this is, one, economists don't like it because it's a hidden tax. You have absolutely no idea with the product you're buying how much of that is a tariff. And you'd like to know taxes. That's the way it is. You know what your sales tax is. You know what your income tax is. But it's a hidden tax. So if they say they're going to put 10% on imports, and you go to the store and buy something that used to cost $20 and now it's costing $22, the store says, well, it's the tariff, and most people don't pay a whole lot of attention to it. And like I said, they're in good enough financial shape, so they just spend $22 and buy what they want. When in reality, that's not the real reason why it's up $2. The tariff is on the import price, not the retail price. So if it was sold at $20, then that means the store bought it for $10 from the wholesaler, who bought it from the importer for $5. So the tariff is only 50 cents. That's all the federal government's getting. You're paying much more. It's inflationary to you. Secondly, it's very regressive. It's on goods. And those at the lower end of the income spectrum, they spend more of their money on these sort of goods than the general population does. The general population, those at the higher end, spend it more on services. So the tax rate is much higher on those at the lower end of the income spectrum. And that's one of the reasons why we pretty much moved away from tariffs in the United States to income taxes. Plus, Congress has learned that you can tax a whole lot more on income than you can on goods. Here's another example of the tariffs. The dark blue line here is the revenue stream in terms of dollar amounts that has come in. The shaded area is a percent of the total revenue. It's been a very, very small amount that they brought in. But the new world that we're living in right now, tariffs appear to be something that will be something in our future. The other issue with tariffs is that it really doesn't fix the trade deficit, which is quite large, because although we might import less and buy domestic-made products, the thing is that there's a retaliation and we don't export as much. So it doesn't really have much of an impact on that. It's just a hidden tax revenue. But what's interesting is how this economy has changed over the many years. And this is why it's become a very important political concern and a very powerful one, is the fact that manufacturing, which used to be a very dynamic part of the US economy, really hasn't been in the last few decades. And this is an interesting chart going back to the 1950s in the fact that if you take a look at GDP, which is a very dark blue line, that's how the economy has grown over time. And you can see the pace has picked up in the last few decades. Then we break it into what's going on with personal spending on things like services that have grown, and also take a look at the gray, the manufacturing. The manufacturing between 1950 and roughly 2000 grew a little bit faster than the overall economy. But since China joined the World Trade Organization, you can see it's pretty much flatlined. An awful lot of jobs that were done domestically have been exported overseas. Now, there's also been improvements in technologies, so there's been a great deal of efficiency going on at the same time, and that's also reduced the amount of people that are needed for manufacturing. But generally speaking, if a manufacturer can get something produced where unions are illegal, environmental laws are not nearly as strict in the United States, the cost of creating that product is very, very low, and it more than offsets the cost of transporting it across the Pacific, and that's what we've seen. So the chart on the left-hand side, the dark blue line, just shows manufacturing employment as a percent of total employment has really shrunk. You know, it was around a third before the war. It went up quite a bit, of course, but now we're talking just 8% of the workforce. And manufacturing just really has not done well in the last 2 years, despite how well the economy has done. You can see that here on the right-hand side. This is what they call a diffusion index. Anything above 50 is expansion, anything below 50 is contraction, and you can see the manufacturing sector has been in that contraction mode pretty much for most of the last 2 years. So this is the big focus and concern for the administration, is try to bring back an awful lot of manufacturing jobs to the United States. In terms of energy, drill, baby, drill is a very powerful political slogan that always gets everyone's attention. The issue is that the government doesn't do the drilling. The United States, it's private enterprise, and they do so when it's profitable, and they have been. We have record amount of oil being produced in the United States, and as a percentage of the share of the global amount, we're the only ones that are really growing. But there's a couple of very important things here that should be understood. First of all, the way economists look at this is that the United States, they say, is energy independent in the fact that we produce more energy than we consume. And that, of course, is a good thing. We don't produce all our energy, and I'll get into that in a moment, but we produce so much that we're able to export it. And you can see that here on the left-hand side. Now, this is a measurement of total energy. So it's not just oil. It's natural gas. It's hydroelectric. It's everything. But the interesting part here is that we're able to export some energy, even though that we're still importing some. And how we get our energy has changed over time. It doesn't change quickly, as you can see, this chart here on the right-hand side from the 1950s to the present. You don't all of a sudden go to wind energy or something like that. But one thing you can see is quite specific is that the dark blue coal has been declining in the usage. The biggest increase that you see is that bright blue, which is natural gas. And the natural gas is a result of the fact that most of the oil production that we have is through fracking now. It's more than half of the oil production. And a byproduct of that is natural gas. So we have an awful lot of it. So it's relatively cheap because it is a byproduct of the oil. Oil use is pretty consistent in terms of nuclear. That is also pretty stable. The growing part is renewable, but it's a long, slow process. So it's not going to be replacing much. As you can see, it's less than 10% of where we get our energy. In terms of oil prices, they've been extraordinarily volatile over time. I have this chart in here because for those that are old enough, you may have forgotten how cheap oil used to be not too long ago, like in the 1990s, compared to what it is right now. But oil prices, it's pretty hard to get an oil price above $100 a barrel. Although the United States, we might be able to afford it, the rest of the world couldn't. It would put them into a recession and oil prices would collapse. So nobody wants oil prices too high. Oil prices anywhere in the range of $50 to $80 is something that seems to be sustainable for a long period of time. On the left-hand side, it just shows our oil production. And again, this is an important part of where we're getting a lot of our energy based on that earlier chart. You can see the dark blue line is the amount that we're exporting. It was made, Nixon had made exports illegal. That was reversed. We can now export, and we do export oil. We still import oil, and you can see that in the bright blue below that. The net is the fact that we're importing around 2 million barrels per day, much less than 2000 when it was around 9 million barrels per day. So that's the important thing. The reason why we do export and we import is mainly because of the infrastructure and the type of oil. Oil that comes from fracking is very different than oil being pumped out of the ground. So an awful lot of the refineries are not set up for that. And two, we don't have the infrastructure from where the fracking going on to bring it to a refinery. It's much easier to bring it to a port and export it. But where we import oil, again, this is a really important issue. On the chart here on the right-hand side, you can see most of the oil that we get, 60% of it, comes from Canada. 10 to 15%, it's pretty volatile right now, comes from Mexico. So about 3/4 of our oil come from our best trading partners. That's a very nice position to be in. In terms of the oil that we get from the Persian Gulf, it's around 7%. Back in 1970, when all the serious problems with oil started, it was about 1/3. So you can see that has shrunk significantly. So the sources of our oil that we import is from a very good place. But this is what I was talking about earlier. These are the three major areas of where you see oil production. The dark blue is the United States. The bright blue that you see is OPEC. And that sort of gray blue at the top, that's the rest of the world. The United States is the only place that we've seen an increase, a significant increase in production since the pandemic. OPEC has pretty much stayed the same, and the rest of the world has also stayed the same. The other part that we're seeing going on with the economy is in payrolls. As I mentioned, the unemployment rate is very, very low. The amount of people being hired each month, it's slowing down. It's a volatile number on a monthly basis. It's the one that the markets get all excited about. It's the first Friday of each month. But the pace is slowing down. In 2021 and 2022 is very strong because that's when people were coming back to work after being laid off. So that was not sustainable. What the Fed would like to see is that this number stay above this yellow line, 100,000, because that's about what the amount of people coming into the workforce is each month. So as long as it stays above that, then that means the economy is growing, and that's exactly what the Fed wants to see. But we're seeing an aging going on in terms of where the hiring's happening. It's not happening in the cyclical areas, the go-go areas. It's happening in the areas where it's pretty much constant. This shows all 13 major areas of work. The average is the light blue that you see there. If you look at the ones that are above that, again, those are the areas that just have hiring month in, month out, because people generally don't last too long in those professions, such as education and health sciences. It's an extraordinarily hard job, and the tenure doesn't tend to last much more than 5 years. Yes, it does, but you have a lot more turnover than in other occupations. Now, construction, this is a little bit different. This is a highly cyclical business because it's dependent upon interest rates. But with the infrastructure bill going on, all the demand for AI and creating energy and data banks and so forth, demand for workers is very strong, so that's why that's positive. Government, most of the government workers that are hired are at the state and local level. That again is something that's constant. And leisure and hospitality, think going to a restaurant, think going to a ball game or something like that. That area. The areas, the big go-go cyclical areas like in tech and law and business, that sort of thing, that growth is much slower. So we are seeing a maturing of the business cycle. But with the cut down and deregulation that's being discussed and probably will happen, we may start seeing a boost in an awful lot of those occupations. In regards to inflation, inflation has calmed down quite a bit from what it used to be. And that's a good sign for the financial markets and the Fed. This is an interesting chart in terms of just showing what caused inflation to be so high and what's causing it to be at that level that we have right now. The dark blue area that you see there, this is the contribution of food. This is back when we had the first batch of avian flu, and egg prices more than doubled. Chicken prices increased significantly also. You also had the war going on in Ukraine. So the grains were very, very expensive since both Ukraine and Russia are big exporters of those. And that was threatened quite a bit. Transportation costs were high because oil prices were high. So that's what pushed food prices up. And that's got people upset. Year-over-year change in food prices got up to 14%. History is that it's closer, the long-term average is around 2.5%. So you can see the dramatic change. We hadn't seen anything like that since the 1970s. That's why people were really, really upset. But you can see food prices right now, that's not the case. Food prices right now are around 1.5% year over year. So that's not much of a concern. The light blue that you see was the energy prices. Again, that was war related. Nothing that the Fed could do about that, but finally that calmed down as based on the previous charts that I showed you. The gray that you see there, that's just goods people were buying. But look at that period of time, 2021 or so. I joke about this, but it's 100% true. My wife may have married me for richer or poorer, sickness and health. She did not marry me 24/7 with 2 teenage boys at home and a house full of dogs. So what did people do? Well, they bought stuff. They bought big screen TVs, sofas, backyard barbecues, Pelotons. Remember those? Everybody was buying stuff to keep the family amused because they were all home together and they wanted to keep some sort of sanity. So they were doing so at a time when the products were limited because of COVID, and that pushed up those prices. But as soon as you got the vaccine, people's habits changed. You don't need to buy a big screen TV every year, despite what my teenage sons tell me. Those prices have come down, and you can see on a year-over-year basis, those are negative right now. Where we see the inflation is the green areas, services and housing, or what they call shelter. Housing is still very, very expensive in terms of the price appreciation. A lot of this has to do with the fact that we're greatly underbuilt. And services just has to do with higher wages. There's just not enough workers to do an awful lot of the service jobs, whether it's cutting your lawn, getting your car fixed, going to the dry cleaner, whatever it may be. Those continue to be a driving force on the high side. But what's interesting is how economists and Wall Street look at inflation and how people look at inflation. It's two very different ways, and this became a very important political tool that was exploited quite well. By and large, the financial markets just look at the year-over-year change. What's interesting here is the chart on the left-hand side. You can see how prices have moved up on different things. This is how people look at prices. And you can see this over on the right-hand side, and I think it's the best way to describe it. The light blue line is showing food prices on a year-over-year change, and it's 1.6%. So it's below the long-term average. So the Fed and the financial markets are pretty happy with that. But the dark blue line is the absolute change, and you can see food prices are up 26%. I used to pay $1, now I pay $1.26, sort of thing. And that's how people look at it. And people are different. The shaded area, that's the income. So you can see on average, the income is higher than what the prices were. So economically speaking, on average, people are better off. They're earning much more than they did before compared to what they're paying on prices. But people don't think that way. It's a human behavior thing. The reason why they're earning more money is because they're the ones that worked hard. They put in the overtime. They did this. They did that. It's them that cause the higher levels of income. So the fact that prices are higher, that's, well, if they don't like the administration, you blame the administration. If you like the administration, you blame corporate greed. That's how it plays out. But it also brings up an interesting aspect, the social issues that are going on here. These are all averages that I'm talking about because that's what drives the economy. It's the overall issue. But those at the lower end of the income spectrum, inflation actually is a severe problem because more of their money is spent on things like food, which is 26% more expensive. It's on rent. They didn't refinance their house and lock in low mortgages. They have to pay rent, and rent is increasing faster than overall inflation. And other things, like car insurance. Car insurance got up to around 20% increases. It's now around 11% year over year. That's a big part of their budget too. So a bigger share of their monthly spending is much higher. So economically speaking, it's a severe social problem for them because their quality of life has not been nearly as strong. And that was, again, one of the biggest issues that came out last year in the election is to focus on that sort of issue, because that's a big difference from what people have that have bonds and stocks that are appreciating in value. They own a home, they've locked in liabilities. It's a much different scenario. So there's the social part of this, and then there's the other part, which is the economic part, and that's what's driving the economy. Home prices, as I mentioned, you can see here, the dark blue line, there's the change. You can see how it continues to move up outside of the global financial crisis. There was just that one time in the 1980s where it was actually on a negative basis. Home prices and rentals, you can see here, and how the CPI is calculated. CPI still has it at a very high rate, and it will be a little while before we continue to see inflation in the housing sector slow down. But you can see this in terms of people that are going to buy a house here on the left-hand side. This is the mortgage payment for a median-priced home where you're putting down 20%. Back in 2020, when interest rates were very low, that mortgage payment was less than $1,000 a month. Now it's more than $2,000 a month. It's expensive, and it's a bigger share of what they're earning. And you can see that over on the right-hand side, where the amount of that mortgage payment is around 26%. The long-term average is around 18%. The lows following the global financial crisis, when people didn't want to buy homes that much, you can see it was around 11%. But it's very, very expensive. And again, this becomes another social issue in terms for young people that are trying to buy a home. I mean, everyone who owns a home, it's fantastic, but if you're trying to buy it, it's very difficult. This, of course, is based on the local area in terms of their zoning, and that's a problem, is that they just don't want high-density housing. The population is growing. You need more housing. If people want to live in one area, then you need high-density housing, and a lot of places don't like that. And the biggest problem is the fact that there's just not much supply. Usually with housing transactions, it's not just new people buying a home. It's young families that are growing and want a bigger home, or it's older families that want a smaller home. You have that transaction always going on. On the left-hand side, you can see that the mortgage rate in the dark blue is around 6%. But for most people that have a mortgage right now, it's averaging around 4%. They're in no hurry to give up that low-level mortgage and get a higher one that has a higher cost because the payment is up so much. So that becomes a problem, and they're just not selling. So that's the issue. And you can see over on the right-hand side that most of the homes are those ones that are already existing. That's 90% of the homes that are sold. So if they're not for sale, there's not many homes, and that's, of course, pushing up the prices. The other issue is just supply, new homes coming into the market. From 1965 to the global financial crisis, we were building at about 1.1 million homes per year. Now it's around 800,000. It's down dramatically. There's just not the supply, and that's why housing is so expensive. Credit card balances, people talk about an awful lot, that they exceeded $1 trillion. Yeah, it's a big number, but the issue is, can people pay it off? And they can. And you can see that on the right-hand side, the delinquency rates much lower than the long-term average. And again, this has to do with the fact that many households have delevered quite a bit. And we'll rush through a couple of more of these so we can just open it up for some questions at the end. But in terms of consumer sentiment, it's still very low compared to what it was before the pandemic or the average. And a lot of that has to do with food prices and energy prices. People are quite upset about that sort of scenario. What's interesting is how polarized the country has become. This just shows when you look at that same data and you break it down into whether people identify with the Republican Party or the Democratic Party, that depending on who's in charge, alters their view. Didn't happen so much in the early 2000s, but you can see as soon as an election happens, there's a dramatic flip in terms of the attitude. So that's a big driving force on people's view of the economy. But this is the important issue to me, personal savings rate. This is the amount of money you have left over after you've done your spending. It's very, very low. And the reason why it's low, we think, is because the Americans are quite confident about the economy. They have no troubles and feeling that they could, if they got laid off, they could get another job, that their financial situation is in good shape. And so they're comfortable spending money. And that's what's been driving economic growth. The deficit, of course, is a big problem. You can see it here on the left-hand side. The right-hand side is the more accurate way of taking a look at our debt versus that of the economy. And it's very, very high. At some point, government will deal with it. But as I mentioned earlier, they're spending about 40% more than they're bringing in. It's not a major political issue at this point, but at some point it will be. And you can see how things have changed over time in terms of how people or the government gets their money. Individual income taxes are the bedrock of it. Corporate income taxes is the interesting one. You can see in the light blue, that shrunk. It used to be 30%. Now it's about 10%. Not to be cynical, but I think that has an awful lot to do with strong lobbying in Congress. In terms of how the government spends its money, government social benefits and transfer payments, these are things such as Social Security, Medicare, Medicaid, those are the biggest issues. That's if they're going to ever deal with it, those are the ones that they have to tackle. And they're not willing to do so at this stage. So we don't expect that to change a whole lot. But the outlays are very high. There's talk about cutting back $2 trillion in spending. That's difficult, mainly because of the fact that discretionary spending is only 1.7 trillion. We'll see how that plays out. There's a long history of trying to cut back on what they call the government, but in most cases it doesn't do very well. Really, the only successful one was right after World War II when we moved to a peacetime economy from a wartime economy. In terms of the Fed, they're going to be lowering interest rates some more. This is just the long-term history. That's the rate right now for the federal funds rate. The way that the Fed looks at it and the markets look at it is compared against to what, I'm sorry, this is show what their plan is, as I mentioned, that it will continue to fall. But it's this light blue line here. This is what the neutral rate is. Anytime the interest rate is above that, it's considered restrictive to economic growth. If it's below it, then it's trying to grow the economy. Right now, the dark blue line is above the light blue line, so it's still restrictive, and because they're still trying to slow down the pace of inflation. And they'll get there, but there doesn't appear to be any risk of recession in the future. In terms of the outlook of the economy, this is just a measurement of GDP. The columns are the quarterly change. The dotted line is the long-term average. And the light blue is what the market's expectation is going forward. Growth of around 2% as far as the eyes can see. So it looks as though the economy will continue to do well. The financial markets should also do well. Stock prices continue to do well because cut back in taxes and also in terms of regulation. So that's a whirlwind tour of the economy, all the major sectors, and what's impacting it right now. And I'll be very happy to open it up for some questions, if I may.
Thank you very much, Paul. So yes, if you have any remaining questions, please send those to the Q&A, but we have a few to start with. I have a question. So with this is going back to what you started with, but with the Tax Cuts and Jobs Act set to expire at the end of this year, is the quote unquote one big beautiful bill expected to extend the current tax rates and fold in changes to SALT and make Social Security payments tax-free? what is the likelihood that happens by the end of the year?
Whether it's one bill or several still remains to be decided. The House wants one bill, the Senate wants several. One thing I think is quite clear is that the Republicans do want to extend the tax cuts that were put in place in the previous Trump administration. That's paramount for them. How to get there is a very difficult challenge. It all depends on how much they're able to cut back in terms of government spending. That will help out an awful lot. But the world's becoming more focused on the federal debt. $36 trillion is an awful lot of money. And, but the economy is so much bigger, you've got to find investors that want to buy it. And it's been pushing up interest rates. So we'll see how it plays out. The SALT tax, the state and local tax deduction, that one's still up in the air. It's interesting that they brought that back. They were giddy to get rid of it, mainly because it's the Democratic states that have the high tax rates, had the biggest impact on last time around. But it's an important political issue, so it may be increased a little bit, but not as much as probably or it won't be nearly as much as what we've seen in the past is what we're reading right now. It's not that important to the Republicans as it is, of course, to the Democratic senators.
Sure. I have another question. And I think the answer to this could go very, very long, probably longer than we have. But the question is, how is the government going to stabilize Social Security in the coming years to make it viable in the future?
This is something that I find absolutely frustrating. Politicians talk about how they're not going to disturb Social Security, but by doing nothing, they're disturbing it. It's no different than a captain of a ship saying, I'm not going to do anything to wreck the ship. Meanwhile, the ship has an enormous hole in it and it's taking on water. Social Security is a very simple business model. Cash in, cash out. If the cash isn't coming in, then the cash can't go out. So to propose not taxing the income from Social Security means less cash coming in. That means less will go out. The way Social Security works is simply the fact that we've had baby boomers over the years that have been paying in more than was distributed out. The Social Security Administration bought treasury bonds with the extra. They built up an enormous trust fund. That trust fund will work its way down to zero in 2033 or 34. Because right now they're using some of that money to pay out. This is something that they should do, and it's not that hard. You either have to increase Social Security taxes a little bit or reduce benefits, but make a decision. Social Security is a very important part to the strength of this economy. It allows people to retire without the risk of poverty. Which is not the case in most other countries in the world that don't have a Social Security program or pension plan of some sort. And it wasn't the case before Social Security. 2 out of 5 Americans, this is their only retirement. Another 2 out of 5, it's the majority of their retirement. This is something that I think government needs to fix. And like I said, they just don't want to because they have to make the hard decision of either raising taxes or cutting benefits. And that doesn't appeal to a congressman at all. Right. So I wish I had an answer for that.
Me too. So one other, we've got time for, let's say, 2 more questions. We've got one here. One issue that we worry about is China. So it seems like there are steps taken to prop up their economy by the government. What's the likelihood that a Chinese economic collapse would light a fuse on the rest of the global economy?
If there was a collapse, it would have an enormous impact on the rest of the global economy. It's the second largest economy in the world. They're the biggest exporter in the world. They're also the biggest importer of oil in the world. An enormous population. It would be catastrophic. It's an interesting view, but what they want to do is basically be the cheapest exporter in the world again. That's where they think that they can grow their economy. Most of the growth over the last few decades has become because of infrastructure spending and exports. you can build so many bridges. At some point that doesn't make economic sense. So that part has slowed down the economy dramatically. The housing situation has been extremely brutal, much more brutal than what we had in the United States. To give you a quick example, if they're going to build a tower and you want to buy, an apartment in it, you pay for it. If that contractor does not build that structure, you still have to pay for it. It's weird. Those are the laws there. So that's the what so many people are so upset, and that's why so many Chinese have cut back in terms of spending on things. There's so much uncertainty. The country closed down for COVID. So savings is extremely high because they don't have the safety nets that we have in the United States. And that's the big problem for them. So to them, they need to be the cheap exporter. And that's why the United States and many other countries are concerned about that, because that will decimate their manufacturing. So the need for tariffs are probably there. I would be surprised to see a collapse. The old joke from economists in terms of China's economy is that it's 65% capitalistic and it's 55% command and control. I mean, if they want to do something, they do. They can move thousands or tens of thousands of people from one city to another. They can do all sorts of things that you can't easily do in the United States. They will do the stuff to keep it going. The question is will it continue to be the major powerhouse that it had been for the last few decades? We think that's not the case. It'll be an economy, but it won't be the major powerhouse and the major growth that it had been. But we do not see a collapse.
All right, one last question and you sort of alluded to it there with your answer, but on the topic of tariffs, right? You had the chart earlier in the presentation that showed the gap between GDP, consumer spending, certain things, measures like that, and manufacturing, and how they had been so close for so long and then spread. What sort of bridging of that gap does it seem like tariffs could potentially do? Because I think the intention is bringing manufacturing back to the U.S., but the rub with that is how long and how much. Can you speak to that?
Yeah, bringing manufacturing back is pretty hard. Using a tariff for something like that is a good thing to have when the unemployment rate is very, very high, because it will add to people getting jobs, and it's a lot harder when the unemployment rate is low. Secondly, technological improvements have changed so much since those jobs left and started leaving in the 1980s. An awful lot can be done by robots or something, so if the jobs did come back to the United States, one, it probably will not go back to wherever it was beforehand. It'll go to a place with cheap electricity because that's what they need, and well-educated people because the demands for those sort of jobs require greater education than it did in the past. Two, those jobs that just require labor. Labor is very expensive in the United States. It's much cheaper to have labor overseas. So things like sneakers and shoes probably will never, ever come back to the United States in mass like it had beforehand. So that probably won't change. It may not be in China, but it probably will not be in the United States. Where the United States has the ability and where it does do very well in terms of its manufacturing, and it does. Keep in mind that although the amount of workers in manufacturing fell, the amount of output increased. And it's those areas that require a highly educated workforce. So it's things like pharmaceuticals, it's things like automobiles. That's the area that will continue to see a great deal of growth and some strength.
Sure. Okay.
The high profit margin stuff, which is what you want. You don't want American people making things like a pencil. It doesn't pay well enough, or if it did pay well enough, no one wants to spend that much money to buy the product. What you want is to be able to produce high profit margin products for export and domestic sales, and import low profit margin stuff, things like food or simple knickknacks, that sort of thing.
Yeah, right. All right. Well, Paul, thank you very, very much for your time today, and appreciate everyone that's joined us. And as I mentioned earlier, we will have a recording of this available within the next couple of weeks on our YouTube channel. If there are any questions that you had, but maybe you didn't ask or you didn't get answered, please reach out directly to your advisor. But again, I thank you very, very much for your time, and I hope you have a good rest of your day. And thank you again, Paul.
Oh, thank you. This has been wonderful.
Okay, thank you guys very much. Have a good day.